Hey, hi, this is Gautam. So in this video, I would be doing a bit of deep dive into the health insurance sector in India. Okay. And if in case you have not watched my video on how to analyze a general insurance or a non-life insurance business, then I would really recommend that you watch that video. If in case you haven't watched that, that's fine. But I would really recommend that you do that because in that video, what I've done is I have used Warren Buffett's, I've used the shareholder letter by Warren Buffett, in which he explains how to analyze insurance, general insurance business. So I've used his method of analysis in that video. All right. I after really reading through his explanation and really applying that to the Indian companies, okay, I fell in love with the insurance business. All right. Okay. All right. Okay. So now back. So let me pull up my screen. Okay. And let's do a deep dive of specifically the health insurance business. All right. All right. Whenever you start with the analysis of any industry, first you got to like look at global benchmarks as well. So in this chart, okay, what I have is I have insurance penetration, the non-life insurance penetration in India. Okay? And you also see the non-penetration of non-life or general insurance in other developed and developing economies as well. So India right now, it's at 1% of GDP. That's the non-life insurance ka penetration. Brazil and China, it's almost double. Indonesia is it's a little low. Okay? So if you, how do we make use of this chart, of this macro, high level macro data? Okay? So how do we make use of this high level macro data? Okay? So let's say sorry, right now in 2024, India ka GDP is almost 4 trillion, that is 4,000 billion. Okay? And general insurance penetration is 1%, okay, which is this year. Okay? So GI, the premiums, general insurance premium would be around 40 billion. All right. Okay. This is 2024. Now, as per estimates, many estimates lying around, in 8 years by 2031, okay, India ka GDP would more than double. So let's say it would be $8,000 billion. Okay. And let's say general insurance penetration in India by then would be closer to the current Brazil and China ka non-life insurance penetration. Okay. This is an assumption. Okay. Just to basically get a sense on what could be the growth in general insurance at a high level. Okay? So let's say it's closer to 2%. So penetration of general insurance in 8 years or 10 years is 2% from 1% today. Okay? So these premiums of 40 billion would grow to 160 billion. So the growth would be 4x if this happens, if this were to happen in the next 8 to 10 years. So definitely, okay, regardless of whether this 2% number is whatever, there will be a lot of growth in insurance because, especially non-life insurance, because this is a very under-penetrated sector in India. All right. Okay. All right. Now let's move forward. Okay. So in this chart, I'm specifically focusing on, I want to focus on the health insurance. Okay. So if you see health insurance business, okay, in fact, for the last 3 years, forms more than one third of non-life premiums, of all the non-life premiums, and it's expected to grow rapidly in the future as well. Okay, all right, just the health insurance piece, which is this. All right, and other non-life or general insurance sectors also would grow. Okay, all right, but health insurance is expected to maintain its contribution. All right, okay. Now let's move forward. Right. So this chart again talks about the out-of-pocket expenses as a portion of the current healthcare expenditure in India. Okay. So if you see the out-of-pocket expenses are very high, they have been declining a little bit, but they're still high, like 50%. It's too high. Okay. In developed countries, so most of this is covered by insurance. Even in the developing countries, if you see China, okay, the insurance, the out-of-pocket expenses are around 35%. All right. Indonesia, it's even lower. Okay. So when you have a very high out of pocket expenses, although they're declining, it indicates there is potential of growth in health insurance. Okay. Because right now this sector is, again, this chart is telling us that this sector is under-penetrated. Okay. All right. Okay. So in this chart, I'm talking about the three business segments within health, which is the government business, group business, and the retail business. The government business is essentially the government health insurance policies, okay, which are primarily provided by these public insurers like national insurance and oriental insurance and what have you. Group business is the corporate business. Like say you, if you are a corporate employee, let's say if you work in TCS, Tata Consultancy Services, then and if you're covered by within TCS, you are covered by, let's say, national insurance or oriental insurance. Okay? Then basically you are a part of the group business essentially because you have been provided a corporate policy which covers not only you but your family. All right. Okay? But you also could take a as a retail customer, you could take a separate insurance cover, health insurance cover as well. Okay, right? So that is the retail business. Okay. So these are three business. And if you see, retail contributes 40% of the premium, group around 50%. And then you have up top, you have uh, uh, government business, which contributes 7% of the premiums. All right. Now, let's go further. All right. So I know this is a busy slide. Don't get overwhelmed. Just first look at the headline in blue, which is quite interesting. So the government business covers 30 CR lives, okay, at a premium of less than 300 rupees per life per annum, because this is basically welfare by the government. Okay. All right. Uh, and then you have group business, which is the corporate policies. Okay. 20 CR lives are covered in this business, okay, and the premium of around 2,300 rupees per life per annum. And then you have the retail business, which covers only 5 CR lives, okay, at a premium of just under 7,000 rupees per life per annum. All right. So retail may you have only 5 CR lives covered, okay, right? But you get a higher premium per life. Okay. Now, if you look at this chart, okay, these bars, these are the health premiums, okay, and these lines are the number of lives. Okay. So if you see this blue line, this is the group lives. So if you see group lives covered have been steadily growing. Abhi almost 20 CR lives are being covered. Okay. All right. As more and more people join the workforce, you would have more people being covered by their corporate policies. All right. Yeah. And the reason why the premiums are so low per life, because their company would be negotiating with the insurer, right, on their behalf. All right. So the premiums are lower. Right. And then uh, you have this line. It was that the number of lives covered in retail was 3 CR. Now it's 5 CR. Okay, so although there has been a growth, but for the last 3 years, it's been range bound. It's around 5 CR. Okay, COVID did give a bump, but after that, the number of lives covered by retail business is only 5 CR. Okay, right. But FY24, the data is yet to be released by IRDAI. Okay, but it's this segment is poised to grow in the future. Even some of the corporate employees, as more and people join the corporate workforce, okay, even many of them are likely to take a policy outside of their company. So they'll be a part of both corporate and the retail business. Okay. All right. So, but if you like sum up right now, I know there'll be an overlap in the group and retail even now. Okay. But if you right now just sum up all the three, these numbers, 5, 20, and 30. So around 55 CR lives out of 145 CR lives are covered in India. So that's less than 40% of population is covered in India. So there's tremendous potential for growth in this segment in health sector. All right. Okay. Right. And I would say both in group and retail. Okay. All right. Now let's go on to the next one. See, in the last slide, we saw that retail may only 5 CR people are covered, but they pay a higher premium. Okay. All right. Vis-a-vis the group business. All right. Group and government business. So now if you look at this chart, right, what it's saying is that 73%, okay, 73% of sales of the policies that are sold in retail, that is sold by individual agents. So it's a agent, it's a push product. Agent say sale hota hai. Okay. So, and that's the reason why, if you saw my last video, that's why you would see in all the, in retail, the expense ratio is high for retail because you have to pay for agents' commissions. Okay, vis-a-vis, if you look at the group or the corporate business or the government business, hardly not much sale is done by agents. Okay, it's mainly by brokers or and there's direct sale that happens. Okay, and obviously, if your company would be negotiating for you, they will actually negotiate it for the entire all the employees in the company, right? Okay, so the expense, customer acquisition cost is much lower in group and public in group and government business than in retail business. Okay, retail business mein obviously the customer acquisition cost would be higher. All right, so that's why you would see group and government may you'll have lower expense ratio, but in retail you'll have a higher expense ratio because here you have agents. Commission to dena hi padega, and plus so customer acquisition cost yahan pe higher hoga. All right. So now with that understanding, let's go to the next slide. All right. So before I walk you through the message in this slide, I think it's important that I make you familiar with some of the terms used in this general insurance industry, like what is float, what is claims ratio, what is expense ratio, etc., etc. I think then you would be able to appreciate this content even more. Although I've covered all these terms in detail in my last video, and I'm going to put a link to that video. Okay? But let me take a small detour, and then we'll come back to this slide. All right. All right. So I wanted to make you familiar with a few insurance terms before we proceed with the subsequent content of this video. Okay. So see, let's take the example of ICICI Lombard. So let's say this company collects premium from its customers. Those premiums are called gross written premiums. Okay, so this is what is collected in the form of premiums from its customers. And then ICICI Lombard is also is also mandated by the regulator to pay a certain premium, okay, as reinsurance. So what it will do is it will pay a premium as reinsurance, okay, to, let's say, General Insurance Corporation of India. So in the case if there are extreme risky events, okay, then this reinsurer would come in and cover that additional risk if it were to present itself. Okay, and the amount of reinsurance premium that needs to be paid out depends upon the business line. Okay? It's different for different business segments. Say for marine, it will be different. For fire, it will be different. For health, it's different. And insurers may may even want to go above the prescribed limit set by the regulator. So any which ways, this reinsurance premium is netted off from gross written premium, and what you're left with is net written premium. ठीक है? अब ये net written premium, insurers, okay, they're required to provision. Okay, they provision insurers. They provision a portion of these net written premiums. Say for unexpired risk, okay, it's called reserve for unexpired risk, okay, and for, let's say, future claim payments. Okay. So if so insurers, they can always draw on this reserve, okay, for any claim payments in the future. Okay. All right. So what you're left with is net earned premium. Earned, itna bacha, na kamaya aapne, net earned premium. Okay. Now, from this net earned premium, okay, they obviously need to meet their expenses. A lot of these expenses are upfront in the form of commission payments to agents in underwriting policy or what have you. Many of these expenses are upfront. पहले ही अगर कर देते जाते हैं. And then also you need to pay claim payments which occur in that year. So that present year itself, and this provision is set aside for any future payments. Okay, so this is current year. So any which ways, what you're left with in that particular year is when you net out expenses and claim payments from the net earned premiums that you're left with, what you left with is underwriting profit. Okay, now it may be a profit, or you may just break even. There may be no profit, or it may be negative. Any of these three things can occur. Okay? Many of the insurers in India, general insurance companies in India, they are making an underwriting loss. Okay? All right. So, see, obviously, if they are making up underwriting profit, then it's great. But even if they are just breaking even or they're making a small underwriting loss, that's fine. Okay? They are still making money. I'll tell you why. Because, see, this provision, okay, this provision eventually is added to something which is called float or investment assets. Okay? On this float investment assets, okay, they earn an interest income. Okay? All right. So business model यही है. So whatever surplus they are left with, they keep on adding to float. That's why Warren Buffett says this is the money, that we have but we don't own. Okay. All right. And then of course any underwriting profit it would of course be eventually added to this as well. Okay. And of course you'll keep on earning interest income. Then again you'll uh, your float would increase next year again. All right. And जो भी whatever provision you set aside, whatever risk reserve you have here, again would be eventually be added to float, and then again any underwriting profit if in case you have that also eventually would find its way and be added to float, and again उसके ऊपर आप interest income कमाओगे. So this is broadly how this works. The business model works. Okay. All right. So your combined ratio, okay, is basically a sum of your expense ratio, कितने expenses हैं, okay, plus your claim ratio. कितने claims है. Claim ratio is also called as loss ratio. It's the same thing. If you look at this, यहाँ पे, this equation here, okay, see, we netted out expenses and claims from this net earned premium to arrive at underwriting profit, right? Okay. So this expenses divided by net premiums, okay, is expense ratio, and this claim payment divided by net premium is your claim ratio. Okay, so that's what claim ratio really is. Okay, all right. And just to refresh your memory here, if in case you're forgetting, insurer collects gross written premium. From that, portion is paid out as premium to a reinsurer. Then you're left with net written premium. From net written premium, you provision or reserve a portion to cover your future claim payments, which may occur far in the future. Okay, and then you're left with net earned premium. Net earned premium में क्या होता है? आपका expense ratio, मतलब expenses आप हटाते हो, you remove them, and then you also remove your current year के claim payments to arrive at an underwriting profit. All right, or it may be an underwriting loss. So let's say, let me just change the color real quick. All right. So let's say the net earned premium, okay, is 100, okay, and the expenses, let's say, is 30 rupees, and the claim payments are 65. Okay. So the underwriting profit or loss, the profit that you left in this case is 5 rupees. All right. Okay. So depending upon the expenses or claim payments, you may make an underwriting profit or loss. All right. Hopefully that detour was helpful. Okay. Now let's come back to this slide. See, the key message here in this page really is that the retail segment, it's an attractive segment, okay, because it has a lower combined ratio vis-a-vis your group and your government segment. Okay. And the reason why it has a lower combined ratio, that is because it has a very controlled claim ratio. It has a very low claim ratio vis-a-vis other segments. Okay. All right. Although it has a higher expense ratio because it has so many agents, etc., to sell policies, but overall it has a low combined ratio because of a very controlled claim ratio. ठीक है. तो अगर आपका, if you have a lower claim ratio, or let's say the claim ratio is, let's say, below 100, okay, इसका मतलब you are turning an underwriting profit. Okay. If you are turning an underwriting profit, okay, इसका मतलब what it means is, okay, that your cost of float is negative. मतलब कोई cost ही नहीं है. The cost of float is negative, meaning the cost at which you are able to accumulate float and earn interest on it, okay, the cost of acquiring that float is negative because you are making an underwriting profit. Okay, that is what it means. Yeah. If the cost of float concept is not clear, that is fine. Please watch that video, the last video. I'm going to perhaps link it up here. Okay, you'll understand it. You'll understand it much better, very comprehensively in great detail. Okay, but abhi ke liye just understand, okay, retail segment is attractive. Okay, and and they are turning in underwriting. Many of them, the players operating in this segment, are turning in underwriting profit. Okay, all right, which makes this segment very attractive because the cost of raising money for them is close to zero or perhaps even negative. Okay, all right, let's move forward. All right. So here, what we see is, okay, Sahi insurers or standalone. Now, see, we spoke about retail business. Now we are within retail business, right? There are standalone health insurers. Okay? Standalone health insurers, they contribute to more than 50% of retail business. Retail segment may you have other insurers, public insurers, and you have multi-line insurers like ICICI Lombard as well. But standalone health insurers like ICICI, like Star Health, Niva Bupa, they are contributing more than 50% of the premiums in this retail segment. In fact, Star Health has is almost exclusively present into retail business. Okay. So Sahi or standalone health insurers have a lower cost of float versus other insurers. Basically, what we are saying is they have a lower combined ratio. Yahan pe, they have a lower combined ratio vis-a-vis other insurers. So again, we are trying to establish the attractiveness of Sahi insurers here in this slide. Okay. Especially the retail segment, and within retail segment, we are saying Sahi insurers are actually doing a pretty good job at managing their cost of float or combined ratio. All right. So another quick point that is renewable. Okay? See, you remember just a while back we spoke about the business model. In that business model, when I was talking about business model, the implicit assumption was that the customers of these insurance companies, they would renew every year. That is, they would stick with the insurance company year on year. Okay, then only the insurance companies would get those premiums, right, year on year. All right. So renewal rate is very important in this business, right? Otherwise, you will stop getting those premiums, right? See, so if you look at retail, retail has a higher renewal rate than group and public insurance business. All right, and within retail, Sahi companies have a even higher renewal rate, than private insurers. All right. Okay. So this is very important. Okay. See, retail customers, it says that they are typically remain loyal to a single insurer over a long period of time. All right. So again, that makes this segment very attractive because you kind of get this continuity of premiums over time, year on year. And in the absence of it, you'll obviously stop getting those premiums and you'll stop getting that float and you'll stop earning that interest, which otherwise you could have made. All right. So this is very important. All right. Otherwise, the business model, the entire business model that we spoke about last slide, that definitely would be impacted. Okay. All right. Okay. So now let's just talk about a couple of other things as well before we wrap up. So another interesting aspect about these standalone health insurers, okay, is the number of network hospitals they are in. Look at the number of hospitals and compare it with other insurers. Okay? So these standalone health insurers, they are present in every nook and corner of the country. They have a wide distribution. So obviously, as a customers because they are present more or less everywhere, so they have more access to they have a better access to customers, and customers are more likely to get policies from these Sahi insurers. Okay? So that is what we are saying here. Okay? And the other thing is, see, retail insurance is a push product. It's an agent assisted product, right? So look at the number of insurance agents for Star Health, for Care, and Niva, all these standalone health insurers. Okay? In fact, Star Health has 7 lakh agents. All right. Care has under 3 lakh, so on and so forth. Okay. So, and all the other insurers like ICICI Lombard and all the other multi-line and government business and public insurers, they don't have these many agents like these Sahi companies have. Now, it has some downside as well. If you aggressively increase the number of agents, then those agents may have these aggressive sales target, and there may be some agent mis-selling that may happen. All right. So that is something you got to be, as an investor, you got to be careful when you analyze these companies. All right. And by the way, I've analyzed Star Health a couple of years back. Then analyzed it and valued it again last year. And that analysis I had put up on LinkedIn. Okay, and I had a blog on it as well. All right. Anyways, so I think these two things are very important, which again make this Sahi segment attractive. All right. But again, the downside is they are present in just one uh, insurance segment, which is health, because they're standalone. Okay. Whereas some of the other businesses like ICICI Lombard, they're multi-line insurers. They're also private. Okay. But because they have this diversified presence, because they have this diversified presence. So if in case a segment is not doing well, they could perhaps focus on the other business segment. All right. Okay. So obviously, if you are if you just concentrate on one segment, then if in case that segment is not doing well, then obviously your business may suffer a bit. So that's something that you got to keep in mind.
Recording in progress.
All right. And see, I know I spoke a lot about Sahi insurers, that they are indeed Sahi, standalone insurers. They are indeed like pretty good, pretty attractive. Okay. But I certainly did not. But before you consider an investment in any of the companies operating in that space, Star Health is already listed in a listed standalone health insurer. Niva Bupa is also going to come up with an IPO pretty soon, which is again a Sahi company, standalone health insurer. Okay. I wanted to quickly just walk you through this table again, which I've covered at length in my other video on the business analysis or how to evaluate non-life or general insurance. So I've covered all these points at length. So I really recommend you watch that. Okay. So again, the reason I bring it up again in this video is, see, before you go out all convinced that, you know what, Sahi standalone health insurance is indeed a very attractive segment, then you also got to look at, multi-line insurers as well. Let's say take ICICI Lombard. Okay. ICICI Lombard, although it may not have as many agents right now, or it may not have the kind of presence in terms of hospital coverage as some of the Sahi companies, because it's a multi-line insurer. It's not only present in health, it's present in other insurance businesses as well, which again could be which is because it's well diversified. Okay? And well diversified also has its own benefits. Everything has its pros and cons. Well diversified also has its own benefits. Okay, because if you look at this chart, if you look at the quantity of float, or the quantity of investment assets in comparison to the premiums that these insurers have been able to accumulate, okay, you would see all these multi-line insurers, okay, they have been able to accumulate 2x investment assets or float, than the premiums. So their float size is 2x of the premiums, whereas Sahi, it's just 1x. Okay, and the more the float, more amount of float you are able to accumulate, the better it is, because you would be able to earn a higher interest on that float. Okay, all right. So I just wanted to kind of leave you with that point, that everything has its own pros and cons. And in fact, because in ICICI Lombard, it has a higher float size vis-a-vis, it has a higher float size. Okay? Then what it means is they are able to drive a higher leverage as well. Okay? That means because of it is higher leverage, they have a higher ROE, okay? Which is a very important metric for insurers. All right. Insurers with high ROE over extended periods of time, they generate a lot of shareholder value. All right. All right. So I just wanted to just walk you through a couple of metrics before we conclude, before we summarize. So here I have the market share of these different insurers within the retail health segment. So if you look at Sahi companies, they're very high market share. All of them have expanded pretty aggressively. And within Sahi companies, Star Health has expanded the most aggressively. It has 7 lakh agents, which has helped them get a market share of almost 30%. And then you have Care Health at 18%. The Niva Bupa, which is going to IPO pretty soon, has a market share of around 13% within retail health. All right. And then if you talk about multi-line insurers, ICICI and Tata AIG, both of them have a 3% market share within the retail health segment. All right. Now let's talk about the claim rejection ratio metric. Let me flip over to a different document. All right. So I've pulled this document from IRDAI. Okay. So here I have the claim rejection ratios of these different insurers. So if you look at standalone health insurers, okay, look at the claim rejection percentage. Standalone health insurers year 2022 13% claims were rejected, and year 2023 12% claim rejection ratio. All right, it's a pretty high claim rejection ratio. And within Sahi companies, these standalone health insurers, Star Health, okay, has a pretty high claim rejection, around 17% 2022 and around 19% 2023. Okay, so it's pretty high because they have a lot of agents. There must have been some agent mis-selling, which is being reflected in these high claim rejection numbers. Okay. And if you look at private, these multi-line health insurers, and obviously they are not just in health, so these numbers are for all their products. You look at ICICI, the claim rejection is sub 5%. Okay? They have a 3% market share in retail health. So इनके claim rejection ratio कम है. It's 5%. Okay? So anyways, the broader point is, see, this certainly is not a very pleasant metric, okay, for Sahi companies and especially Star Health. Okay, and so if you remember the claim ratios for all these insurers that we had looked at, and I think it was the other video, and overall for Sahi companies, we also looked at the overall claim ratio for these Sahi companies was under control. It was very reasonable, around 65-66%. Okay, and one of the reasons is because they are maintaining a tight ship in terms of paying out these claims. All right. All right. So, and since they have a pretty controlled claim ratio, they have been able to show underwriting profit as well. Okay. All right. So anyways, this is something to keep in mind. And all these, despite having a higher claim rejection ratio metric, okay, interestingly, these Sahi companies, they have had a very good claim renewal rate as well. In fact, around 90% or 90% plus claim renewal rate. Okay, so this is pretty interesting. Okay, they're having a lot of claims rejected, but again, people have been renewing policies. Okay, all right. Now let's conclude. All right. So now to just summarize, first we look at the low penetration in the health insurance segment in India. Okay, there's certainly very low penetration, so there is massive runway for growth. And within health insurance, the retail segment appears to be pretty attractive because it has very high premiums vis-a-vis other business segments, and it has a very low cost of float, a low cost of funding. Okay, it has a lower combined ratio. Okay? And then you have and you have three types of insurers. Okay? You have public insurers, you have private insurers, private multi-line insurers, and you have standalone health insurers. Public insurers, okay, they are largely present in government, welfare insurance policies, okay, and they have presence in group and retail as well. But majorly, public wale, they are insurers. They are present in government and group. Okay, and then you have private multi-line insurers, okay, which again are present across the three business segments. Okay, and but relatively they have a lower presence in retail. And Sahi insurers, okay, Sahi insurers, they have 50% of the book is retail business. Okay, all right. So they enjoy these higher premiums, which come in the retail segment. So Sahi insurers, they enjoy these higher premiums, and they have this lower cost of float as well. Okay, because as I said, they have a massive presence in retail segment. Okay, now we just looked at an unpleasant metric for these Sahi companies, which is they have a very high claim rejection rate. Okay? Although they have a high claim rejection rate, but they have been able to demonstrate high renewals as well. Okay? So it depends upon you whether that's a deal breaker for you or not. Personally, for me, okay, it's not a deal breaker as such, okay? Because again, there's a massive growth runway in this segment. Okay? But obviously, that metric needs to be tracked in the future. Okay? And then we established that retail is attractive, and within retail, Sahi segment is attractive. Okay? And it comes with its own share of risks, like the one that we just spoke about. But then you cannot obviously write off multi-line insurers, okay? Because multi-line insurers like ICICI Lombard, it has been more judicious in its expansion within retail. Okay? And it has a and multi-line like ICICI, it has been able to accumulate a higher float vis-a-vis its premium collection, okay, given that it's present in multiple products as well. So ICICI Lombard and some of the other multi-line insurers, they are pretty interesting as well. All right. Okay. All right. And both ICICI Lombard and Star Health, I have written a blog on them last year. Okay. All right. Okay. So hope this video was helpful. Okay. And I'll really recommend that you watch the video on how to evaluate a general insurance or non-life insurance business. Okay. I have put that video, and I've applied Warren Buffett's methodology in giving that analysis out in analyzing non-life health insurance. So please watch that video. It would round up your understanding. All right. Okay. So hope this was helpful. Thank you. So if you've come this far, I'm hoping you found this content helpful. If you did, please follow me on LinkedIn and subscribe to my YouTube channel if you want to learn financial statement analysis, modeling and valuation, and also how to analyze different sectors. Okay. And please share this video with people you think who may benefit. All right. Thank you.